in the green. Hero MotoCorp as well on the sale of these Harley-Davidson bikes looking pretty good. Here's the first take on the index. Straight off the back, it's a 100-point up move on the Nifty. The Sensex is up almost 370 points now. So looking pretty good for the market. The Bank Nifty is up 300 points. Top of the charts is HDFC Bank, 1.5% higher. Grasim following suit, up 1.5% as well. And Divi's Labs is up about 1%. Hero MotoCorp is also up about 0.5%, so looking pretty good there. While you have something like an LTI Mindtree that's batting for the bulls this morning. On the downside, barely any stocks. So Dr. Reddy's is the only one that's down about, and that too barely about 0.1%. Otherwise, it's a very, very good looking market. 19,800 now on the Nifty, holding with some effort. And the advance decline ratio as well is well in favor of the advances. But plenty of action in the broader market.
Well, that's right, Sonia. The stock of the morning has to be CEAT. That stock is flying away. And what it's done is it's had a positive rub-off, both on MRF as well as Apollo Tyres. Both of them are up more than 2%. So keep an eye out on both those two. Delta Corp, the stock is half of what it was a few months ago. That stock has opened up with a gain of close to around 1.5%. Grasim, they have announced a rights issue and they're saying they're going to be using it for debt repayment for the capex plan as well as for corporate purposes. So that doesn't include any kind of money going to a group or company, like Vodafone Idea. So that's why the street likes that. The stock is up in today's trading session. A few other notable movers with big volumes. SCPC, now that stock has moved, with large volumes. So just keep an eye out on that one. PC Jewelers, one of those stocks that have been a rank underperformer actually. But that one, in fact, is up close to around 7%. Big volumes out there. MMTC, limited float, but the stock doesn't budge. It's just moving one way upwards. But caution on board out here. The free float in the market is very, very limited, only around 7% in the market. JK Tyres, well, that's another one that's up close to around 5.5% this morning. And Bank of Maharashtra as well came out with its set of numbers yesterday. That is up more than 2%. Suzlon Energy as well continues to move up close to around 2.5%. So quite a few gainers. But if you look at it from the highs of the day, we have slipped close to around 25 points. So unable to sustain above that 19,840. Still early days. We need to get back to those levels and sustain over there. That's what could trigger a big short covering bounce. For the time being, HDFC Bank, stock of the morning.
Well, absolutely. And, the market, by the way, is up, 85 points now, 19,800 plus on the indexes where we find ourselves at. And it's a very, very good opening. I remember the tire names. I think it was a quarter before, not the last quarter, but the one before that. MRF came out with numbers, big beat, and that sparked a rally in tire stocks, which lasted for many weeks. We're going to see a repeat or something like that. We'll find out, but their entire pack is doing well on the back of what, of course, CEAT has done. A few other names. You've got ICICI Securities, which is up 7%. Stocks at about 674. That's a very large move coming through. Latent View is coming up with a 4.5% gain. Stocks at 429. I think we mentioned Scient DLM, which is up 6.5%. Stocks at about 734. KEC is another one, which is up 4% this morning. Bombay Dyeing is up about 5%, 159 on Bombay Dyeing. There is Viatech Vabag, which is up about 5.5%. Karur Vaisya is up about 1.7, 1.8% as well. So, it's a market which seems to be starting on the front foot with lots of names participating in the broader market as well. Loda, that is Macrotech Developers, is starting with about a 1.5% cut. And yesterday we saw, out of the blue, a big rally in fertilizer names. FACT, Madras Fertilizer, Deepak Fertilizer. Today, maybe slight pullbacks, right? FACT is down about 1% or so, but nothing more. GNFC is down a little bit. But watch this space because these stocks were up 7-10% in trade yesterday. 85 points is what we have on the Nifty, 19,815 at this point in time. Harsha Upadhyay is a market master today. He's President and Chief Investment Officer, Equity at Kotak Mahindra Asset Management Company. Harsha, good morning. Good to have you with us here. Thank you very much for your time. Actually, let's just start with the auto ancillary space and the numbers I'm sure you've seen what CEAT has reported. Your thoughts on it's a space which has been kind of a dark horse, has done very, very well. Not just the OEMs, but maybe OEMs more than auto ancillaries this year. Ancillaries did very well over the last 2 years. What's your view? I mean, tires as a space and, the sector as a whole.
Good morning, Prashant. Clearly, auto sector seems to be doing quite well in terms of the volumes. Whether you look at any of the subsegments there, all of the subsegments seem to be growing at a reasonable pace. So clearly, for auto ancillaries, this is a big boost as they get much of their volume from OEMs. And even the replacement market in many of the auto ancillaries have picked up. So overall, I think the growth trajectory for auto ancillaries seem to be quite strong. And we have also seen margins improving as commodity costs have moderated. Although we should keep in mind that crude has moved up, and at some point of time in the near future, there could be some pressure on overall margins. But nevertheless, all auto ancillary segments seem to be doing quite well. And in particular, tires also seem to be seeing the benefit of lower raw material costs at this point of time and better margins. As we move ahead from a medium-term perspective, we still continue to be very positive. We do have a couple of positions in the tire segment in our portfolios. However, in the very near term, there could be some lag impact of higher crude oil prices.
Okay, Harsha, hi, good morning. By the way, the tire space is the one that's really on fire this morning rather. Not just CEAT on the back of numbers, but there's buying in JK Tires up almost about 8%. Apollo Tires, MRF, all doing pretty well. And I think it was expected that these numbers would be good given the lower raw material costs. But the additional positive impact of a better product mix where they sold higher number of two-wheeler tires and that helped them is something that has, given a fresh set of wings to a lot of the other tire makers as well. Bajaj Finance and Bajaj Finserv, the twins are also doing very well, topping the charts as we speak. Expectations perhaps that the numbers would be good this time. And there's additional news on Bajaj Finance as well. Harsha, hi, good morning. How are you feeling about the markets in general? What is the stand now? Do you put more money to work? If yes, what are the big themes that you're looking at?
Sonia, clearly the undertone in the market seems to be quite positive. While valuations are higher than average or fair range of valuations, I would say that the overall sentiments seem still positive. But we need to keep in mind that from here on, the stock performance would be dependent more on earnings deliveries. I think most of the near-term positives have already been discounted. So I think earnings delivery is going to be crucial for stocks to sustain these valuations or to move higher from these levels.
Hi, Asha. Good morning. Do you think there's a scope of disappointment? At one point in time, the street was very comfortable. Mid-teens growth, the Nifty EPS is very gettable. Now, we could have some supply disruptions that are coming back, given the conflict that's picked up in Israel. It could have repercussions for the rest of the globe as well. Do you think that mid-teens earnings growth is at risk?
I would say that as of now, there don't seem to be too many risks. Yes, we need to keep an eye on what's going to happen on the crude oil pricing side. Yes, as long as the conflict is very, very localized, then you may not have a big impact on the crude oil prices. But if any of the other countries from the Middle East join the war, then I think there is going to be a bigger issue. And that's where I think crude can move up much higher from current levels. So it's something that we need to remember. And at the same time, we have also seen about a 30% increase in crude oil prices in the last 3 months or so, right? From a low of almost $70 to a barrel, we are at about $90 to a barrel now. So already there has been an increase in crude oil prices, which will flow into margins in terms of adverse impact over the next 1 or 2 quarters with a lag. So there is going to be some impact on the margins anyways that is expected. However, at this point of time, at least for the large cap basket, we don't see too much of earnings risk. Over the next 2 years, we are expecting about 16-17% earnings CAGR, and I think that should happen. And even in the worst case, if there is some disappointment, I think there is not much of a valuation discomfort that is there in that basket. However, if you look at mid and small caps, for example, the earnings CAGR is about 25% for the next 2 years. And also the valuations are at a premium to large cap, as well as the historical mid and small cap average valuations. So to that extent, if at all there is a risk in terms of earnings delivery, that is going to be larger in mid and small caps. So to that extent, we remain slightly cautious on mid and small caps as compared to large caps.
Harsha, on financials, we've seen numbers from HDFC Bank, but I mean, slightly top-down view, and there could be outliers here. The view which seems to be developing is that the best maybe is behind on growth, on asset quality. margins, maybe, it's a different story and will depend on what happened on interest rates. But what's your sense, Harsha?
Prashant, the best may be over in terms of net interest margins, but I don't think the best is over in terms of either the growth or asset quality trends. I think we are at a nascent stage of a new cycle in terms of lending. So to that extent, very unlikely that from a system perspective, there will be too many asset quality issues to contend with. Similarly, the growth seems to be quite strong, both on the retail segment, and also we expect overall corporate lending should also pick up over the next couple of quarters further from these levels. So overall, I think the situation is quite good for banking and financial services. However, as we have already discussed many a times in our interactions earlier, there seems to be some pressure on the net interest margin. So to that extent, yes, when you look at financial year 24 earnings growth for banks in particular, as compared to the previous year, there is a slowdown, but it is still the healthy earnings growth, which is higher than the overall market average. So to that extent, this is not a segment that will probably underperform for a long period of time. Maybe it will not perform as much as what we have seen in financial year 23. That's possible, and that's already visible in terms of the stock performance of the sector. Nevertheless, I think it's not a segment where you can avoid. You need to have a position, and from a medium-term perspective, this is likely to continue outperform.
Okay, by the way, JK Tyres is now up 9% and has hit a fresh 52-week high. That's JK Tyres for you. So the street is definitely building in a lot of positives ahead of these earnings after seeing CEAT's fabulous performance. JK Tyres has now risen almost 85% in 2023. So that's the move there. But Harsha, you said you're bullish on the tyre segment and the auto sector also is doing well. But where do you see the valuation growth even now in the OEMs? Is it in names like Maruti, M&M? Do you like the commercial vehicle makers like Ashok Leyland? If you can just split it up for us segment-wise.
If you look at the near-term growth trajectory, I think except for tractors, everywhere there seems to be a reasonably strong volume growth trend. And we have also seen a lot of new models coming and hitting the market. So to that extent, I think the excitement still continues on two-wheelers, passenger vehicles, and also commercial vehicles seem to be doing reasonably okay. So all these segments are expected to show better volume as we go ahead, and margin should also improve. So overall, auto is one basket where you will see significantly higher earnings growth as compared to the market expectation of about mid-teens growth for Nifty. So to that extent, I think while some of these positives have already been discounted in the stock prices, but we do believe that there is more to come. And this should continue to outperform the overall market over the next couple of years.
All right. What about the state elections up ahead? Do you think that's a risk in the near term? Because that could go either which direction. Though for 2024, the street is definitely factoring in that the current government, the BJP-ruled government, does continue with their policies and also all that they've already started.
Nigel, it's always very difficult to predict election outcomes. I mean, we struggle to predict where the markets are going to go, and elections are even more difficult in that sense to predict. All I would say is if the valuations are at reasonable levels, when you enter the election phase, then probably the downside volatility will be less, even if there is a disappointment compared to market expectations. But if you enter the election phase with all the positives already having been discounted and valuations at a very, very high level, then even if there is no disappointment, there could be some profit after that. So this is how we would probably see. We don't really take event-based bets in our portfolios, but depending on the overall valuations, we will see whether there needs to be a defensive tilt to our portfolio or not. As far as the current valuations are concerned, we are comfortable with large cap valuations. And as I mentioned earlier as well, a mid and small cap segment is where we have slight nervousness. And it all depends on where we end up before entering the elections on these segments. And depending on those valuations at that point of time, we will probably take a further view.
Okay, Harsha, we'll leave it there. Thank you very much for your time. Great speaking with you. And it's always a pleasure having you here on CNBC-TV18. So that's the view coming in from Kotak Asset Management Company. The market is up just under 90 points, 85 points to be precise. Well, let's stay with markets and let's talk about capital market plays. And Angel One is what we are talking about. It routinely now comes up as one of the top ideas when people talk about how to get exposure to this secular rise in retail market participation that we've seen. It's also seen as a mix between, sort of a consumer tech play. Dinesh Thakkar is chairman and managing director at the company. He's joining us now to talk to us about their performance and, of course, a little more than that as well. Dinesh, great to have you with us here. Good morning, Prashant this side, and thank you very much that you're able to make it on very short notice. So thanks.
Thank you. Thank you very much. My pleasure.
Dinesh, let's just start with, what did you see in terms of new client addition momentum and also order volume momentum at Angel in the quarter gone by? And how has it continued into the quarter that we are in so far? Go on.
See, last quarter was definitely historic because of many reasons. First, we had shifted from our traditional broking app to super app. So that created lots of kind of traction for new to market customer. And last quarter, we were able to add around 21 lakh new customers. And our total customer base has gone to around 1 crore 70 lakh, which is kind of a lifetime high. Our orders also grew by around, say, like 50% year on year. So last quarter, we were able to clock number of orders were around 34 crores, which is again lifetime high. So what we are seeing is that there is a secular kind of rise in terms of new investors who are new to market and who wants a kind of an easy journey and access to market. That is where I think they are loving this approach of super app. And we are seeing that traction of customer acquisition continuing for even rest of this kind of period what we are talking about. I feel that lots of people who have been not been given or not gotten proper access to equity market, and given the scenario where actually inflation is low and return on equity appears to be higher, corporate earning appears to be higher than inflation, lots of youth are showing interest to come to the market and try to explore possibility of how to make second income and how to create wealth out of this market.
Absolutely. Dinesh, hi, good morning and thanks for joining in. You've also had that early mover advantage, right, in this digital push in catering to the younger audience, especially in tier 2 and tier 3 cities. So kudos to you for that. You were telling us about how it's a 1.7 crore customer base now that you're sitting on, which is a lifetime high. But I want to understand from you whether this run rate that you've seen, the 60% sequential growth in new client additions, is it something that you can continue, or is it just a one-off phase? And what is the kind of average growth that we're looking at in client acquisitions?
See, Sonia, I believe that we are in a market which is very underpenetrated, and especially as you rightly pointed out, when we shifted from traditional to digital, our focus was clear that we will target this set of users, not focus only on traders, but focus on tier 2, tier 3, try to create journey where they are able to have an access to market. So I believe this kind of run rate, what we are seeing, it is because of low base of customer in the industry, I would say. So there is huge opportunity. If you look at people who are having PAN account and all that, it appears to be number is around in the tune of 65 crores. And today, if you look at active customer base, it is hardly to the tune of 3.5, 4 crores. So I think there's lots of opportunity for digital players to grow together.
Hi, Mr. Thakkar. Good morning. Nigel on this side. What about your market share? It's slowly been inching up, both in the F&O as well as on the cash average daily turnover. How do you see this number headed? You have gained a couple of percentage points in the last few months.
Yeah. So if you look at new client acquisition, we are at market share of around 22%. And if you look at active customer base, we are yet around a bit less than 15%. So these are lead indicators. If at all you have a good run rate in terms of new acquisition of customer, it takes time to bake the customer in and they understand journey, they understand market. So slowly, gradually, we will see increase in market share. Reason being because we are able to acquire more customer, new customer to the market. So I feel this kind of increase in market share is a bit logical. And if you look at customer addition, until the time we are able to gain market share in new client addition, I think this kind of progression towards acquiring or getting more market share in turnover and all that will continue.
Dinesh, so bulk of the business for you is, of course, still broking as it is for others as well. But you're trying to build it out, a third-party distribution, etc. Is the super app going to be? Since it's already out there, what's the response like, and what will be the share of revenues from that line over a period of time, as you see it? What's the aim, at least?
Yeah. So currently, if you see that most of these revenues for all digital players who are into stock market comes from broking. And this year we introduced Super App. Reason was to introduce more services on our platform. So first, what we introduced in April was mutual fund journey. So if you look at incremental SIP number that we have achieved last quarter, on terms of incremental SIPs that we have achieved, we are number 2 now. We achieved around 725,000 new SIP created on our platform. So focus is to be into multi-service area where we are able to fulfill the requirement of customer in terms of their all lifelong requirement for personal finance. So aim is to be a market leader in mutual fund, market leader in lending business, and we would be gradually introducing insurance businesses on our platform. So slowly we are moving towards introducing our own AMC and even wealth management thing. So it would be very difficult to say how this revenue is going to shift, because if you look at broking and all that, they are growing at a very decent rate. So to revenue mix to change, it will take some time.
Yeah, no, absolutely. So the core is firing well, but so you're saying that AIMS, you want to go into the AMC business as well?
Yes. So already we have applied for license. We have got in principle approval, and we are in the stage of already we have finalized for final approval. So we are expecting this financial year end.
And do you want to go on the passive side, active side, or will it be a overall offering with both?
No, Prashant, we believe a right product for retail investor is ETFs and all that. So we would be on a passive side. Rest of this mutual fund, we are a distributor for all mutual funds. So we would not like to go on an active side.
And on the lending side, Dinesh, could you tell us your plans? Is it already started, or you will launch it?
Prashant, we are integrating our app with a few manufacturers and trying to fine-tune the journeys. We would be distributor in that area. We would not like to expose our own books for this. So I think by the end of this financial year, we would start lending to our customer base.
Yeah, and just as a kind of a target internally, where would you want all of these broking? What would you like the sort of number to be over? Because that also reduces. The broking business used to be cyclical. Hopefully, it is not anymore with client additions over the last couple of years being absolutely fantastic. But where would you like the non-broking revenues to be as a percentage of the total over a period of time?
See, over a period of time, if I take 5 to 7 years, we would like to see broking remaining in below 50% of our total revenue.
Below 50, okay. And that
below
is...
50.
Okay, all right, got it.
Okay, so broking to be below 50% of your total revenue, got it. You were telling us about various things, and I think this is important even from a shareholder standpoint, right? You're going to be introducing the insurance business on your platforms. You're going to introduce AMC and your own wealth management business as well. You have a new management on board. Ravi Sinha has taken over as the Chief Product and Technology Officer. Can you tell us what is the plan in mind over the next 12 months, apart from what you've spoken about so far, in terms of client acquisition, in terms of growth? What will he be bringing to the table?
Yeah, so he is a new CPTO that we have brought in, because we have to work on quite a new architecture so that we are able to put multiple services on this app, where not cluttering too much of an app or not making it too crowded. So his main responsibility would be to look at new technologies and bring in new areas where we can increase our efficiency and keep our app simple. So
Got it.
he has a lots of experience. He has worked with Flipkart and Yahoo, and he's restructuring the whole thing so that it is aligned to every business needs. Because now we are getting into multiple businesses, like we are dividing our broking, one into digital, second into assisted business, where we see big opportunities. So technological approach for both and product approach for both would be very different. And plus we are
Absolutely.
adding mutual fund and wealth management services and trying to build a lending platform on the same platform. So it requires quite a kind of like creative thought process in terms of how do we look at our tech stack.
Absolutely, and I think that is the need of the hour, right? To make your digital presence stronger. And I'm glad you're doing that. I'm sure your shareholders would like it as well. Just coming back to the core numbers, in Q2, your cost to net income has improved sequentially. I think right now it is standing at somewhere around 50% plus. Is this something that you can improve upon further over the next couple of quarters?
In every quarterly, I have told that we are not looking at cost efficiency currently. We are looking at spending on technology and improving experience of customer. As we are getting into new verticals, we have to take lots of cost on that side. So revenue from that will come later. It's an upfronted cost that we take. So we like to maintain this margin at 50%. We would not look at cost efficiency at this juncture, where actually we are looking at growth from other businesses.
All right, Dinesh, we'll leave it at that. All the best and congratulations once again on a strong set of numbers and the growth path that you have charted out for yourself. A big beneficiary of the improvement that we've seen in the equity cult as well, Angel One, sitting with growth of around 2% Let's slip into a quick break. On the other side, Dhruv Shringi, who's the Chief Executive Officer at Yatra Online, will be joining in to discuss their Q2 earnings. Later in a special segment, Quarter Se Quarter Tak, we put focus on expectations from the auto sector this quarter. Jay Kale of Elara Capital will join in to give us his expectations. Stay tuned.
Welcome back. Well, the market's holding well on the green, so let's focus on one of the latest debutants on the last trade. Yatra Online, well, in its first results since listing, the company has reported a healthy revenue growth, while the margins have also expanded. The company has signed 19 new corporate clients during the second quarter. To understand more about it, we have Mr. Dhruv Shringi, the Chief Executive Officer at Yatra Online. Hi, Dhruv. Morning. Thanks so much for joining in. Well, give us a couple of details. Quarter one we have. But how is quarter two shaping up? Are you seeing similar traction on, for your business?
Hi, good morning, and thank you for having me on your show. You would have seen that we posted strong numbers in the last quarter. The secular trend for the travel industry continues to remain quite strong. If you look at the data for the first 9 months of the year as well, domestic aviation has grown almost at 29%. So we continue to see strong growth happening on the aviation front and on the domestic hotel and holiday front. So overall, the macro tailwinds are quite strong, and that continues to bode well for the industry and Yatra in particular.
Okay, all right. Dhruv, in the first half of the year, have you grown at a pace which is faster than your industry? If yes, what is your updated market share?
Sure. So if you look at the industry data, the industry in the first quarter would have grown about 14.8% year over year, and we guys grew almost in the mid-40s. So there's a significantly faster growth rate than the market that we're witnessing at this point. Our market share would now be touching in the range of about, somewhere in the 6.5 to 7% range of the overall aviation market in India.
But I think earlier you had said that you have a 9% market share in value terms, right? So you're saying your
That's
market
right.
share has
So-
fallen?
No, so in customer terms, it would be around the 7% mark, but because we are servicing more the top end of the customers, right? So the larger companies, the big four accounting firms, the big software technology companies, so the spend share would be higher. The spend share, which is the value term number, would be in the range of 9 to 10%.
Okay, so from this 9 to 10% value market share that you have, what is your target, say, over the next 1 year?
See, our expectation is that, if the market is growing at about, early teens, we would ideally want to grow between 1.5 to 2x of market growth. So our expectation is to continue to grow significantly faster than the market.
Okay, 1.5, 2%. Got that. Can you tell us what is your targeted margins for this year? I think your adjusted EBITDA margin target was at high teens for over the next 3 to 5 years. But in the very near term, by the end of FY24 and 25, what are you looking at?
See, we're already trending in the mid-teens right now, and we continue to see good operating leverage in the business. So my expectation would be that, we would be somewhere in the mid-high teens in the near term before getting into, hopefully the 20% kind of range over the course of the next 3 years.
Dhruv, how does that happen? What's the roadmap or rather the mechanics of increasing margins to 20 and beyond? Because, corporates want to cut costs across the board. Travel and, stay, etc. There's a cost. And you're an intermediary. The only big advantage of the lever you have is offering a lower cost, right? The lowest cost possible.
Which is exactly where we come in, right? And we are helping corporate organizations, especially the large ones, organize their spends. We work closely with them in terms of making sure that, spends are happening within policy. There is no leakage of spend that happens. We will work with them in terms of negotiating better deals for them from the airlines and jointly with the hotels. So we provide a single platform, and it's a complete platform play. Once the platform is integrated within the corporate organization, it becomes easier for us to sell multiple products at a much lower incremental cost. And that's where the operating leverage for us comes in as well. So it's a benefit both for the organization, for our clients, where we are able to deliver value by getting them better pricing and making sure that there is much tighter compliance on the spends. And likewise for us, by cross-selling multiple products and services on the same platform, we're able to drive better operating margins.
When these clients that you said that you added, usually it's only, a corporate would only have sort of Yatra as an intermediary, or would it have multiple? Are these usually exclusive in nature? That is one. And second, how sticky is this? I mean, do sort of corporates shop around as well if they find or is it very sticky? I mean, once you sign on, you kind of stay on for a few years.
Yeah. So in terms of the exclusivity, roughly about 2/3 of our top 100 customers are exclusive with us, and the rest would be shared. In terms of, again, the stickiness, see, once we deploy a technology solution and we integrate tightly within the organization, it continues to remain a highly sticky proposition. 91 out of our top 100 customers have been with us for more than 3 years, and 67 have been with us for more than 5 years. So there is a high amount of stickiness which is there once we end up implementing the solution. And do take into account that we are a fast-growing company at this point, so the numbers will only strengthen as we go forward from a stickiness perspective.
All right, Dhruv, from the money that you all raised, you all had also highlighted that you all could be looking at some M&A. What's the outlook out there? Should we hear about something in this calendar year or in this fiscal year? And what could be the potential size of the acquisition?
Sure. So in terms of M&A, that's obviously something that we've looked at closely in the past as well. We've done a few acquisitions that we've successfully integrated, and we would continue to adopt the same model going forward as well. In terms of timings, I think M&As do tend to be a bit tricky from a timing assessment perspective, but it's something that we are keeping a close eye on and actively evaluating.
Okay, all right. Dhruv, we'll leave it there. Thank you very much. Good luck, and hope to speak with you again soon. to get a sense of business, maybe mid-quarter or something. Thank you very much for joining us with that perspective. Let's go across to our next segment, a special segment, Quarter Se Quarter Tak. We sort of train our lens on a particular sector, and today it's autos. Sonia has walked across, and she's going to tell us what to expect from the space. Sonia, over to you.
Well, thanks a lot for that. Let me start with the best part, which is the stock performance, right? Auto stocks have skyrocketed in 2023 with gains of anywhere between 20 to about 60%. Let's take a look at some of them. Tata Motors has been by far the best performer this year with a 62% gain, followed by a lot of the other stocks that have gained anywhere between 40 and 42%. However, it's going to be a mixed bag this time in terms of the sectoral performance. So the volume growth momentum has remained steady for both passenger vehicles as well as commercial vehicles, but volumes are weak for the two-wheelers and tractor sector. The margin improvement, though, has come through because of softening commodity prices and operating leverage. So let's go deep down into the volume growth first up. Now, this quarter, the passenger car segment continues to see a low single-digit growth in volumes. The street is expecting just a 5% growth in passenger cars, and there are definitely signs of demand moderation that are visible. The industry inventory levels remain quite elevated at around 330,000 units. As on September end, the demand for small cars remained very weak, while the waiting period for popular cars are also coming down. So that's a segment that has not been doing well. But looking at the other sectors, the medium and heavy commercial vehicle segment volumes are expected to rise by 18% year-on-year, while two-wheeler volumes are down 2% year-on-year and tractors are down about 3%. So these are two spaces that have not done well, two-wheelers and tractors, as you can see on the screen. Now, the margin expansion is a positive trigger for the company. The EBITDA margins of the auto OEM universe X of JLR will expand for the 6th consecutive quarter on a year-on-year basis. And this is the kind of expansion that we are expecting across the board. The strongest margin expansion will come through for a company like Maruti, followed by Bajaj Auto, Ashok Leyland, etc. Let's end with the valuation table. And if you look at it, within two-wheelers, TVS Motors now the most expensive stock, trading at almost 30 times forward. That's FY25 PE, while a couple of others like Hero MotoCorp still continue to trade, cheaper than their peers because of not too much of a recovery in the rural market. Let's move on to the passenger vehicle space. Maruti is now trading at 24 times FY25 compared to an M&M trading at 17.5 times. Of course, it's not an apples-to-apples comparison because M&M has a tractor business as well. But let's now take it with the commercial vehicle space, where Ashok Leyland is definitely the stock that is the most expensive at 17 times, while Tata Motors at 11.5 times. There again, not an apples-to-apples comparison because Ashok Leyland is a pure play commercial vehicle player. But Jay Kale, who's the Senior Vice President Research at Elara Capital, joins us now to tell us what to expect. Jay, we just laid the foundation of what the sector could do this quarter, but you tell us which are the companies that could do well, which are the companies that could move to the back burner this time?
Yeah, good morning, Sonia. So, in Q2 FY24, of course, this is one of the quarters where, all the stars are aligning, so to say, that, you've got favorable raw material prices, you've got good volume growth, in anticipation of the festive season. The, volume ramp up has been pretty good in Q2. And at the same time, for various companies, the mix has also been more on the premiumization side. So the premiumization trend has continued as we move up towards the festive season. So, and also, normally the festive discounts that come in, this time festive being in Q3, those will be booked in Q3 and not in Q2. So Q2 is, probably one of the better quarters, where we will have a benefit of volumes as well as margins. And, like you mentioned, Maruti specifically seems to have a pretty good QOQ margin expansion led by premiumization and volume growth. And then, of course, two-wheelers, again, there will be some of them which will have a favorable mix, adverse mix. But I think Bajaj Auto within that seems to be pretty well placed. Same with Hero MotoCorp and TVS. I'm sure there is some bit of impact of adverse mix. So I think all in all, a pretty good quarter. And I think all eyes will now be on the festive season, because how Q3 and Q4 volumes shape up will be a function of how the festive season pans out.
All right. I wanted your thoughts also on what's happening in the tyre space, because that news is immediate, right? I mean, you've had a very good performance from CEAT, and now all the other tyre stocks are running up. But how are the valuations looking for the sector now? Which is the stock that has more valuation upside?
I think, tires, last few quarters, they have continued to surprise on the margin side. I think Q2 also, with CN reporting a QOQ margin expansion, given that it has also come by gross margin expansion, one would have a positive read-through for Apollo and MRF as well. And that's why we're seeing most of the tire stocks on the upward trend. But, one has to be careful in terms of how the margin trajectory moves. Tire sector has been very volatile in terms of margins. With recent increase in crude and natural rubber prices, you could see some softening of margins in Q3 and Q4. But for the moment, I think the going is quite good for the tire space.
Okay, the going is good for the tire space. Where else are you seeing traction? Now, two-wheelers is interesting, right? Because the volumes year on year have still fallen, but the managements are very hopeful that exports are picking up in a big way. And towards the fag end of the quarter, you've seen an improvement. And on a valuation parameter, something like a Hero MotoCorp is still cheaply valued compared to its peers. Would that be your stock of choice, or do you like any others in the two-wheeler space?
In the two-wheeler space, we are positive on Bajaj, TVS, and Hero, and we have a negative bias towards Eicher. That's how we position our view on the two-wheeler space. Again, festive season is extremely important for the two-wheeler space, given that the 32-day festive season probably retails close to 2 months of a normal month retail. So that's the weightage of this festive season. Based on that, you will see how 2H volumes pan out. But on the export side, I think we are seeing at least the bottoming out. And now the low base has kicked in, and hence players like Bajaj and TVS will favor well. Whereas for Hero, I think it is mainly on the festive. All hopes are hinged on the festive season.
Okay. And in the commercial vehicle space, what's the expectation this time between Ashok Leyland and Tata Motors? Of course, Ashok Leyland is the more expensive stock. But what are you looking at in terms of numbers, and are these valuations justified?
I think commercial vehicles, and especially M&HCV, if you see our expectation for FY24 in terms of growth rate is 10%. Now, to get that, you will see Q3 expectation is a strong double-digit growth. Whereas Q4 will be muted given the last year's high base, as well as a pre-election. There is some bit of softening in terms of the fund flow that happens in this space. So I think full year growth, I think 10% growth still remains intact. Tata Motors, frankly, is not, like you mentioned earlier, also is not really a pure play commercial vehicle. A lot depends on how JLR pans out as well. But on Ashok Leyland specifically, I think what has been encouraging is that the discounts have been fairly under check. Of course, they have increased from a quarter-on-quarter basis and all, but as a trend, if I have to see, they have been under check. So that should bode well for margins for Ashok Leyland as well, as what the case is for the entire auto space.
Okay, all right. Just one final question, because tomorrow you have Bajaj Auto's numbers. You mentioned it briefly, but the stock has already rallied 40% this year. Numbers are expected to be decent this time. What are your own expectations, and what are the things that one needs to watch out for? And do you see a further upside in the stock?
Yes, I think, the key things to watch out would be the commentary on the festive season and the commentary in the export markets. I think these two are the main drivers. And of course, they ramp up on the Triumph side. But one good thing is that the mix of Bajaj Auto continues to improve, and we've historically seen that their delivery on margins have been pretty good. They have been consistent in terms of margin performance, lesser volatile than many other players. But I think the key thing to be watch out for is the domestic festive season and the exports commentary, as well as the three-wheeler. I think they have been doing pretty well in the last 1 or 2 months specifically. So we have a buy rating on Bajaj Auto. We have a target price closer to 6,000.
Okay, all right, Jay. Thanks so much for stopping by and filling us in with your take on all of those auto stocks. We look forward to those numbers. By the way, the first 45 minutes of trade actually been quite good for the bulls, because you have the Nifty that's still holding with a gain of close to around 100 points. That intraday dip is getting bought into, and a few notable stocks that are doing well. HDFC Bank actually is not the big outperformer. ICICI Bank has done quite well. HDFC Life as well has perked up, and Bharti Airtel, that stock as well, it's a larger weight in there, that as well has moved a little bit higher in the last few minutes. And as we're having the chat with Jay, we have Maruti as well that's spiked up. Midesh Thakkar is back with us. Midesh, what's your view? I mean, it's looking quite good. The Nifty Bank, though, it's unable to get past that 44,600, 44,700 odd. So how do you view the indices and your fresh call?
I think the bank Nifty is now closer to about 19,850. The Nifty is closer to about 19,850, which is for me an important pivot. Now let's see if we get a closing around 11 o'clock above this level, and then maybe we'll explore some long. The bank Nifty, while it's been underperforming, moved beyond 44,700. And we are still away from that. I think would add to some momentum. So I think till that happens, I would not bet on the bank Nifty. I would still focus on the Nifty. And on the stock side, I think what could possibly prop up things could be Tata Power, which is now on the verge of getting into a positive mode after about 2 weeks of correction. So I would recommend buying here with a stop at 253 for a target of 270. And the other one which I like is Steel Authority, which is reversing after a long correction. That's a buy as well. Keep a stop below 88.5 and a target of 95 can be looked at.
Oh.
You've got some of these railway names, right? IRFC is popping up 4%. I think Ircon is up about 6%. Railtel is up about 6%. These were not there in the morning, but they are there with decent gains, 4, 5, 6% across the board. And when you see these moves, it's usually the sector which is higher. Just a couple other names. Look, Senco Gold is up another 4.5%. 691 on Senco Gold. Newer names. Metro Brands is up about 4.5%. Iron Exchange that was up sharply yesterday. I think almost doubled in double digits. It's up another 5% this morning. That's Iron Exchange. Data Patterns is up 6%. And there is Viatech Vabag. I mean, actually, the same water purification theme, Iron Exchange and Viatech Vabag. Viatech is also up about 7.5% at this point in time. So yeah, there is a fair bit happening. Also look at these government companies with little free float. Look at ITDC. It's up. ITDC saw a sharp move yesterday. It's up again today. STC India, that is State Trading Corporation, that's up 11%. Not ITD Cementation. But the other one, that's ITDC is what I'm talking about. And the other one is, MMTC, which is, again, small free float, which is up about 5.5%. And I already mentioned STC India. So, yeah, I mean, a lot happening in the broader markets right now. 100 points is what we have on the Nifty at this stage. We'll take a quick commercial break here. We'll come back. We'll shift our focus to the commodity markets. Manisha Gupta will be with us to run us through what she's tracking. Stay tuned. We're back.
Well, big moves in the market, 100 points higher on the Nifty and holding on to its gains. A lot of big, movers in the broader end. Chennai Petro is now up almost about 12% odd. Of course, tire stocks are doing very well. And then something like a Metro Brands, Latent View, all up and about today. But let's shift focus to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking this morning?
Well, I'm looking at the metal as a sector which has seen profit taking for a second straight day today in the markets there. Well, we are looking at prices slip also ahead of the China third quarter GDP numbers that come in today, and the markets are jittery ahead of that as well. The expectation, though, clearly that you could be looking at weaker numbers coming in out of that country there. China also has avoided the rate cut as we saw those numbers come in yesterday, and the weaker yuan continues to weigh on many of these commodity markets within China itself. Also, the government-led infrastructure, especially in case of renewables, has led to demand come back in case of metals. But as far as automobiles or real estate as a sector go, we have seen weaker demand in China continue there. I'll talk about some metals here, and copper prices for one is trading at near 5-month lows. In the Indian markets on MCX, we've seen the prices decline below 700 rupees a kg as well. If you look at LME and Shanghai, we've seen inventories continue to gain onto this one. Also, supply, as according to EIA and International Copper Association, is expected to increase by 26%, but that is by 2035. They also say that the demand will, though, increase by 50% during the same period. So when you look at the longer period for copper as in sense of demand and prices is expected to be much on the higher side. But at this point in time, there is weaker demand, higher supplies, higher production, and that continues to weigh onto the market there. That's about nickel now, where we have seen prices trade at a 2-year lows. That is because the EV battery prices have declined by 10% in the month of August. The inventories have been on the higher side. Demand has slipped, and that's weighing in case of nickel as well. Also, when you look at the steel prices, they have been on the weaker side. That's weighing onto this one. If you look at the inventories, they are the highest in last 10 years, and the prices have continued to decline on back of that. Aluminum for other metal also has seen decline below $2,200 a ton there. We have seen prices decline by nearly 4.5% in matter of last 1 month. And that is a chart that will show you that. If you look at week-on-week basis, only iron ore and steel in some sense are trading in the positive. Rest all the metals are trading in the negative for week-on-week and in month-on-month basis as well. The best gains clearly coming in for the iron ore prices in last 1 week, up by 4.5%. And that is because the inventories have declined for a 5th straight week. We are looking at lower onshore and offshore inventories in case of China there. Also, when you look at the inventories, they are the lowest since June 2020. So iron ore perhaps is your best performer in last 1 week. Every other metal trading in the negative.
Okay, all right. Thanks a lot for that, Manisha. Well, let's hop across to Surbhi. She's joining in to tell us about Cyient DLM as well as ICICI Securities. Surbhi?
Thanks so much for that. So Cyient DLM, it was a mixed bag. It was a very strong revenue growth of over 70% on a year-on-year basis. But the gross margins and the EBITDA margins were under pressure. Gross margins were down 500 basis points due to higher cost of materials that impacted the EBITDA as well. It was flat on a year-on-year basis. EBITDA margins were down 500 basis points. The company also said that they have gotten revenue from the lower margin products, and which has impacted the margins as well. The order book was down 10% on a year-on-year basis, but the brokerages seem to be positive on the overall EMS space, and specifically Cyient DLM. INCRED has an ad rating with a target price of 880. They say a healthy 140 PAT growth is likely going ahead, and the ongoing Israel war is to be monitored. For Motilal Oswal, they have a buy rating with a target price of 870. They expect the company to sustain its growth momentum on the back of strong order book coupled with healthy order inflows, high customer stickiness, and also a strong promoter heritage. They are valuing it at 35 times FY26 PE. For ICICI Securities, it was a strong set of numbers. The revenues were up 34% sequentially. The PAT was up 56% sequentially. And the cost to income ratio was also came in at 44% versus 45% in the previous quarter. Now, most of the revenue growth has come in from the broking and the distribution business, where the growth was 32%. The treasury business, the revenue growth was in single digits. And the issuer and advisory segment, which is the investment banking segment, there the revenue growth was 120%, but it contributes very little to their overall revenues.
All right, thanks a lot for that. Well, Vivek is also joining in. He has KEC and NLC on his radar. Vivek, over to you.
Well, that's right. Both stocks are above, on the back of news flow First, we have on our radar KEC, some more order wins coming in. The company has seen a slew of order wins, over the Q2 as well as, has begun Q3 on a strong note. Overall, the company has secured new orders of over 1,300 crores. Now, this is across various business segments that the company operates in. That is both the T&D segment as well as the cables segment. And this T&D segment, the company has got orders from multiple geographies as well. So, India, Middle East, Australia as well as Americas is where the company has got these order wins from. On the other hand, NLC India, very interesting development. Now, what the company has done is the company has incorporated a wholly owned subsidiary called NLC India Green Energy. Now, this particular company will now start implementing close to 2 gigawatts of renewable energy products, and the total target that is envisaged is close to 5 gigawatts of projects, and this is going to be done by 2030. Now, remember also what the company will do is this particular company will participate as well as execute all of the upcoming renewable energy tenders. So, NLC clearly carving out a niche space for itself as far as the renewable energy space is concerned.
Okay, all right. Vivek, thanks a lot for that. Well, Dalmia Bharat, yesterday in the final hour of trade, actually, last 2 hours of trade, it was an outperformer. Now, in fact, it's giving back some part of that. So let's run you through the con call details first. They're talking about pricing growth of around 30 to 40 rupees. That's in East India, as well as in South India, around 30 rupees. And that's been absorbed. So that's good. They're saying that the volume growth is likely to rebound from the fourth quarter. So the next quarter should be a little bit tepid, as it's been in the second quarter as well. They have lagged industry growth. And the other factor they talk about is JPA acquisition. That's the JP Assets acquisition is likely to be finished by the end of this fiscal. And they've also said the capex for this year, they've highlighted around 6,500 crores. 3,500 crores out of that will be for the JPA asset. What are brokerages saying? Well, we have a split verdict between Nomura as well as Jefferies. Nomura, they have downgraded the stock to neutral. They say that, in fact, the company is lagging in the race for market share. And they expect it to continue to lag from year on as well with regard to industry growth. They're also saying that there's no big clarity on the JPA acquisition, and they are factoring in that this gets closed out in the first half of next fiscal. Remember, the management is talking about closing it out in this fiscal itself. They also go to say that profitability from year on will be driven by realizations because bulk of the cost savings are already done by them. Jefferies, though, they retain a buy rating. They've gone ahead and increased their target price to around 2,680 rupees. They expect the second half of the year to be much better on hopes of price hikes sustaining. So, a split verdict out there, but for the time being, Nomura has got the upper hand.
All right, Nigel, thanks very much for that. Well, 90 points is what we have on the Nifty. Let's just look at the Maruti stock. The pref issue announcement, it came on the exchanges, and we put that out. I think we've seen a bit of a sell-off on the stock. There you go. I mean, it's seen a dip, but it's getting bought back now. Almost down 1.25%, but now just about a 0.5% loss. We'll take a quick commercial break here. We'll come back and we'll have Jayant Dasgupta, former ambassador, World Trade Organization, and Vinod Giri, Confederation of Indian Alcoholic Beverages Companies, joining us to talk about how a potential India-UK free trade agreement will impact that particular sector. And we'll have more on that coming up in just a bit. Welcome back. 90 points on the Nifty. 19,822 is where we are at. The India-UK FTA is expected to happen this time around. The expectation is that we will soon see something by the end of the month getting signed. There are also reports which say that India perhaps will have limited benefits, as many exports to UK already enjoy low or zero tariffs. Let's actually discuss this in some detail. Jayant Dasgupta is former ambassador of India to the World Trade Organization. Vinod Giri is Director General, Confederation of Indian Alcoholic Beverage Companies. Gentlemen, great to have both of you here. Thank you very much for your time. Ambassador Dasgupta, if I can start with you, sir. First of all, if you've been tracking this closely, do you think we will get this done this time around? Because there were some thorny, contentious issues. The last time around, this came close to fruition as well. If you've looked at the relationship between India and UK, trade relations between India and UK closely, do you believe that benefits to Indian companies are going to be limited as is being speculated? Or you think this can be a meaningful booster if the FTA indeed is signed?
You've raised a lot of very important issues. The first one is about concluding the FTA negotiations this time around. And I think the chances are very bright indeed, because out of 26 chapters, in more than 20, I think the negotiations have been concluded. So there are only a few niggling issues left. And of course, there are these 2-3 major things which have to be tied up, which are basically about the movement of skilled professionals, for which India has been making certain demands. On the other side is about the alcoholic beverages segment, which I'm sure my fellow panelists will have more to speak on. And the third one is about cars, automobiles, and a few other items in which the UK is greatly interested. The last issue is about financial services, in which the UK is asking for greater access, and of course the investment treaty.
Sorry,
the UK, yes.
So 20 out of 26 there is agreement, but is it possible in terms of how these things usually happen? If they can't agree on everything, could it be a limited kind of an FTA? Leaving some of these issues out, or usually it is all or nothing?
Right at the beginning or midway through the negotiations, I think that is the right time to decide whether it would be a limited scope FTA and the rest of the chapters will get concluded at another juncture. But in this case, it has been decided that everything should be negotiated together, and it should be a comprehensive agreement. So I think the chances are very bright that we will see a conclusion of the FTA within this year. As far as the benefits are concerned, if you look at merchandise trade, India exported about $11 billion worth of products to the UK last year. And of that, $6 billion, petroleum products, diamonds, machinery items, aeroplanes, wooden furniture, etc., they already enjoy zero duty access to the UK. And about $5 billion worth, which are apparel, leather items, etc., they have certain duties. For yarn and fabrics, it is just 4%. But for finished products in textiles like clothing items, it ranges between 10 and 12%. So with the conclusion of this FTA, hopefully we will get zero duty access for all textile products spanning from yarn to finished clothing items. And so for leather items as well, carpets, etc. So it should provide benefits in that segment for about $5 billion.
Got it. So you're saying that the textile sector, the leather sector are sectors that would be big beneficiaries of it. So just to understand, a lot of the non-traditional sectors, whether it's petroleum products, diamonds, machinery, pharma, that have been big exporters in the recent years, they're already enjoying zero duty, right? So, by and large, apart from the sectors that you mentioned, which is textiles and to some degree maybe even leather, there's not much of a positive impact. Is that the right way to read it?
In the case of merchandise goods, there would be benefits, but it would not be across the board because, as I mentioned, more than 50% of the products are trade is already enjoying zero duty access to UK. But for the rest of the products, like labor-intensive products like textiles, leather, carpet, etc., we will gain.
Okay, let me get Mr. Vinod Giri in as well. Mr. Giri, on the alcoholic beverages side, what is the situation as of now in terms of what are the terms of trade between India and UK? If you can explain the context and then tell us what would an FTA mean?
So the domestic industry generally has been in support of the FTA from the beginning, but there are basically three expectations that we have. First of all, it should create a level playing field. Number two, there should not be opportunities or windows for misuse of the FTA concessions. And third is that it should be both ways. It should be a two-way street. So that's why for the first, we recommended a duty reduction from 150% to 100% now, and then bring it down over 10 years' time to about 50%. Secondly, that's why we say 50%, because that's a kind of difference
Mr.
in the
Giri,
cost of production.
Yeah.
We have
Mr. Giri, sorry.
Scotland.
Mr. Giri, if you can first tell us what are the duties as of now? And,
so as of now,
are we big exporters? Are we big importers? I'm assuming we're big importers, right? But yeah, go on.
We are massive importers. We hardly export anything to Europe.
Correct.
First of all, the balance of trade is some say 95%, 5%, or even more than that.
Okay.
Between UK
and what are the duties right now?
So we have 150% is a flat duty across total duty, which is customs duty as well as the AI duty across all alcoholic beverages coming in. So that's our starting point. And plus we have all the duties in the states, which are different matter altogether, which are very high, of course. So this we have suggested to bring it down from 150% to 100% immediately, and thereafter over 10 years' time to 50%, so that we have 5% reduction every year. 50%, we say there should be the resting rate after 10 years, because as we see today, the difference in the cost of production between UK and India is about that much.
Yeah,
So
Mr. Giri, when you said a two-way street, right, we don't export very much. What is the level playing field then?
Yeah, so here is the big catch is there. Currently, the British laws prohibit or they define whiskey as a spirit which is matured minimum for 3 years' time. Now, we have two problems with that. First of all, it of course pushes up the cost significantly, because in India, we have something called angel share, which is the evaporation loss when the whiskey is being matured. Now, that is in India is about 10 to 15% every year because of the climatic conditions. Whereas in Scotland, it would be 1 to 5%, 1 to 2%. So now we have a situation that 30-35% of the whiskey, if you force that condition, will evaporate. In addition to that, the inventory carrying cost in India, the cost of capital in India is 8 to 10% easily for any company. So you're looking at another cost pile-up happening. Why we think it's superfluous? Because there's enough medical evidence or scientific evidence that the same effect that you achieve in Scotland in 3 years' time can be achieved in India is 9 to 12 months' time. Because of the climatic conditions, we are much warmer. So much warmer climate. So now we have a situation that most of our mainstream products are unable to go to the UK markets because of that condition. It will not be accepted as whiskey. So that severely limits our ability to export. And till the time this matter is addressed, and this is one of our major demands.
Yeah, so 3 years be brought down to what?
So we say ideally there should be nothing. Countries like US and all have no such law. Most of the world has no such laws. As long as there is no misleading declaration on the label. But in case if they wish, it can be 1 year's time, because that will be the parity. But most of the world does not have any such law. It's only the Commonwealth countries. Basically, it's UK, Canada, Australia, New Zealand. They have this law.
Got it. And that's the major big demand, right? To basically, which allows access to the UK market for you to be able to export.
Yeah. In absence of that, I'm afraid that Indian industry will not have much to benefit out of this.
Got it, sir. We are out of time, but we could have probably touched upon a few other topics. But this is something which we will come back to, I'm sure, as we kind of go into the end of the month, and hopefully that FTA is sort of agreed upon, and some of these points are also taken up. Thank you very much, Ambassador Dasgupta, Mr. Giri. Appreciate you, both of you, joining in, and hope to have you back again as we continue to track this one. We'll take a quick commercial break. We are up 85 points right now. 19,816 is where the index is at. It's a very, very steady looking screen. 3:1 in terms of advances to decline, so nothing to really complain. It's a wrap on this edition of Bazaar. Chartbusters will take up all the action in just a bit from now.